Let's take a look at how to record the disposal of a fixed asset. Now, if you are getting rid of a fixed asset before the end of its estimated life, you'll actually need to make two journal entries. The first one will be to update the depreciation right to the date of the disposal, or actually to the nearest whole month. And the second entry will be to record the disposal itself, taking the asset off the books. Let's take a look at an example that I've created down here. We have some equipment that's purchased at the beginning of 2013, $100,000 cost, 12-year life, salvage value $4,000. We're only recording depreciation once a year using the straight line method every December 31. We're selling it off at near the end of September 2023 for $9,000. Okay, so how long did we hold this asset? It has an estimated life of 12 years, but I think we've only depreciated it for 10 years. So we're selling it off a little bit early. In the first journal entry, the amount of depreciation recorded each December 31 is $8,000. How did we get that? Cost minus salvage value divided by our estimated 12-year life should give us $8,000 per year. Now, we've already recorded that for all of 2013 through the end of 2022. Okay, we only record it every December 31. So nothing has been recorded yet in 2023. So if we've recorded the first 10 months already, that means first 10 years, $8,000 a year for 10 years, we've already recorded $80,000. What we need to do now is to update the depreciation for 9 additional months that we had it in 2023 to get it right up to the date of the sale. That would calculate out to be another $6,000 of depreciation. So when you're doing your homework, if it says to record the entry to update the depreciation, that does not mean to record 10 years and 9 months of depreciation. The first 10 years has already been recorded. The update just means how much additional depreciation do you need to record since the last time it was recorded. So 9 more months needs to be recorded. Okay, now we can get rid of the asset itself. The total sitting in the accumulated depreciation account is now the first 10 years that had already been recorded, plus 9 more months, or $86,000. So on our balance sheet, we have $100,000 in the equipment account, and we have $86,000 in accumulated depreciation. When you get rid of the equipment, you want to get rid of the accumulated depreciation account too. Remember that they're linked together in the asset side of the balance sheet. The equipment account has a debit balance. We'll take it off the books by crediting it. The accumulated depreciation has a credit balance. We undo that by debiting it. So if you look in this journal entry down here, let's take it one piece at a time. You get rid of the equipment with a credit. You get rid of the accumulated depreciation with a debit. Now that whole chunk from the asset part of our balance sheet is gone. What I'd like you to think of is when you do this entry, what are we getting rid of? What are we receiving? And the difference is our gain or loss. We've just gotten rid of the equipment and its related accumulated depreciation. What are we receiving in exchange? It says up here that we're selling it for $9,000. So that means I've got cash coming in, $9,000. Now the difference between what you're getting rid of and the cash that you're receiving is your gain or loss. In this case, I need $5,000 more on the debit side to make the entry balance. A debit would be an expense, not a revenue. So we're going to call this $5,000 a loss on the sale of equipment. A loss is an expense account. If I needed a credit to make this entry balance, that would be a revenue, and we would call that gain on sale of equipment. All right, now how can I check that $5,000 loss to be sure that it's correct? Well, the book value of the equipment at the time I sold it off is $14,000. Is that right? Well, we had $100,000 in the equipment account. We had $86,000 of accumulated depreciation. So the book value is the difference, or $14,000. So it's like, okay, that's what I had it for on my books, but I'm only selling it for $9,000. So I'm selling it below book value. That difference is the $5,000 loss. If you were selling it for cash in excess of the book value, then you'd have a gain on the sale of that asset. I think it might be a good idea, before you jump into the homework, to try working the extra practice problem that I put in the Chapter 9 module. Might be good to try that out and look at the solution before you jump into the homework.